just tell us, so therefore, are you choosing to do that? I mean, because you firmly seem of the view that we are definitely not in the early cycle, as data would suggest, mid or late cycle, and therefore, as an asset manager, and congratulations on Mosaic Asset Management, by the way, but as an asset manager, are you choosing to bet on credit or bonds or other forms of fixed income or non-equity asset classes at the current point of time?
So there are two things. One, I'm asset neutral in a sense. Wherever, as you said, wherever is the juiciest part of the market is where I'll bet on. And I think the juiciest part of market today is credit. So the answer to your question is yes. That is what investors should do, and I am doing that.
Why so?
Look.
Why the juiciest? That's my point. You've given us some preamble, but why is it the juiciest part?
See, let's compare equity and credit, and then sort of figure out what kind of risk premiums or extra returns that you can earn from credit. Equity over long periods of time, if you are invested for 20 years or thereabouts, earns about 5% over bonds. Okay. Now, even if you're, let's say, invested in US for 100 years, in India for very long, you will get that much only. And I'm assuming if equity is fairly priced, right? Now, if you were to invest in a decent credit fund, let's say call it performing credit, one of the funds that we will be launching soon, you would also get about 5% extra over bonds. Okay, so in a sense, there is a return parity between a credit risk fund and return of a equity over a long period of time. Okay, but there is a catch here. The catch is that if you are an investor for 20-25 years, it is true. But if you're an investor for 3.5 years, which a typical investor is, then the equity risk premia is only 50-60% of what is available for a long-term investor. You get my point? That because equity is very volatile, on average, if you're a 3-year investor, in last 20-25 years, you would have earned only 3-4% over bonds. So that risk premium for a short duration investor is actually very low. Whereas credit in itself is a 3-4 year duration product. So therefore, whatever risk premium is available to it is available for a 3-4 year investor.
Got it.
Third thing is that as of today, as I made an argument, the balance sheets are super clean. So therefore, you can easily bet on them for the kind of 4-5% risk premium that you seek. But equities are one, expensive, and perhaps we are entering in a mid or late cycle, and therefore the possibility that the earning growth will not be very high is there. So it's likely that equity risk premia, the premium or the excess return that you earn over bonds, remember that, ERP we call it, is more likely 3% over long-term investor as well. Okay, which is 10-15 year old, sort of long investor as well. So for next 3 years, I think the equity risk premium can be terribly low. Versus because balance sheets are squeaky clean, you will earn 4-5% easily in credit. So which is why put all of these together and then look at the balance sheets of corporate, the upgrade and downgrade ratios of corporate. I kind of think that it makes sense for investors to bet on credit right now, to bet on the balance sheets of the company instead of bet on equity to bet on the balance sheet. So you are actually, see, in sovereign bond, you are betting on sovereign. But you say, no, I want to earn that extra return. The way to do it is either buy a bond of firms or buy equity of firms. I think it's a time to buy bond of firms instead of equity. And within that, I think because balance sheets are so clean, as I said, remember that the A-rated company right now, the financial specs of it are equivalent to AA. So therefore, you can go down the rating curve, earn that extra 4-5%, instead of actually buying only AAA.
Got it. So I just want to simplify this, viewers, and Maneesh, correct me if I'm wrong, but I think the point is that in the regular lingo, the risk-adjusted returns, I mean, you invest in equities because you expect a higher return, but you take a higher risk as well. But presumably in the current cycle, and Maneesh, correct me if I'm wrong, the quantum of risk that you have to account for earning an X amount of return is much higher because of all the factors spoken about and the cycle that we may be in relative to credit.
That is true. So equity, as can be observed through the price action, every day upar niche, so standard deviation of 18-20%. So if you are a 3-year investor, you will experience a 13-14% standard deviation. We call it volatility.
Yeah.
But if you are, let's say if you had invested in my credit fund when I used to manage or any credit fund, the standard deviation for a 3-year rolling return would be more like 3%. In a closed-ended fund, of course, there will be no volatility at all. So the walls are very different in two asset classes.
Right.
Whereas there is a risk parity. There is still a catch there, because if you are a very long run investor and plus you have a tax shield in equity, it makes sense for a 15-20 year investor if the pricing or the valuations are at fair level.
Yeah.
Right now, I think everything is a little bit upper niche as far as equity is concerned.
Yeah.